Staying with Canadian banks, as we know, Steve Eisman, made famous in the film The Big Short by betting billions against the U.S. housing market prior to the financial crisis in 2008, joined us 2 months ago with his thesis on why he is shorting Canadian banks. Well, he is back with us now for an update following the second quarter reporting season. Steve Eisman is a portfolio manager at Neuberger Berman. Steve, good to be able to catch up with you again today. Thank you for your time. And let me get your review. What did you think of the second quarter results?
I thought that the earnings quality of the Canadian banks was exceptionally poor, among the poorest I've seen in many, many years.
So we're going to go through those details. Why? Where does that lead you, though, in your short conviction?
I've been adding to positions. I mean, I would say that when we spoke about two and a half months ago, my conviction level on the idea was about a 7. And after looking at the Canadian banks reporting season, I think I'm more at like a 9.
A 9 out of 10 in your conviction. And not right, right. Yes. 9 out of 10, you were 7 out of 10.
Not 9 out of 20, 9 out of 10.
Right. Got it. Let's go through the details. You say that the earnings quality of the Canadian banks is essentially the poorest you've seen in a very long time. What specifically stood out?
Well, first of all, I think I said on the show about 2 months ago that the risk in the short was fairly low because I expected very little revenue growth among the Canadian banks, and that was pretty much true across the board. What I was surprised at was, it's very hard to predict when a credit cycle begins what's going to go bad first. I think everybody, including myself, anticipated that housing would go bad first. And it turns out that it's not housing that's going bad first, it's commercial credits that's going bad first. And the results in terms of bad credit formation during the quarter were actually exceptionally poor. So, one thing that you look at when you look at changes in credit is how much did impaired loans go up during the quarter. And for 3 of the banks, just as to pick on 3, CIBC, Royal Bank of Canada, and BMO, the growth in impaired loans was actually quite high. CIBC, for example, was up about 24%, but that's total impaired loans. Commercial impaired loans at CIBC were up 77% year over year, which is quite a large increase. And so I think there's no question that we're at the beginning stages of a credit cycle in Canada. How severe that credit cycle will be, I don't know yet, and I am not predicting by any stretch of the imagination Armageddon. My only prediction is that we're getting a normalization. And so at this stage in the credit cycle, what you should be seeing is increasing levels of reserves that increase faster than impaired loans, because essentially what you want to do is build money for a rainy day. And you did not see that at all in the Canadian banks. In fact, what you saw was reserves were basically flat. So impaired loans up significantly, reserves flat, which means that the allowance divided by impaired loans deteriorate in almost every case for the Canadian banks.
So
and that's what I call poor earnings quality.
Poor earnings quality, right. But give us a sense, going back to your initial conversation with us, the thesis with respect to the different ways to categorize loans. And the bulk is in essentially stage 1. 90% of the bank's loans are in stage 1. And you were concerned that they weren't accurately depicting the potential for credit losses. Where did that come?
Well, I think we're beyond. I think we're actually beyond that now, because stage 1 is just loans that are current, and you're just making a total guesstimate as to how many of those loans will go bad. What happened this quarter, I think, is much more important. This is no longer theoretical. This is very large increases in actual impaired loans for which you're supposed to be reserving for, really reserving for, and the Canadian banks are not. So we're past theory now. We're at actual fact.
I mean, and we've got the chart that you pointed out to me, and this is in CIBC's quarterly reports to their shareholders. We can bring up this chart, Steve, which you already indicated that the impaired loans on the commercial side of the business for CIBC are up 77% year over year. So you're saying we're already seeing some of the declines, real declines, that are actually being impacted on the bank's balance sheets.
Yeah, I mean, look, a 77% increase, obviously from very low levels, but at a 77% year-over-year increase, and I believe, if I could just look at my paper for 1 second, a 30% increase in commercial impaired loans in just 3 months is an indicator that there's deterioration. Like I said, it's not calamitous, but conservative banking principles should dictate that you should be building your reserves now for a rainy day. And I don't understand why these banks aren't doing that, and I don't understand why the bank regulators in Canada aren't forcing them to do it.
So what do you think exactly should be the right move by the Canadian bank regulators? What could or should they be doing, or what kind of conversations should they be having right now, according to you?
They should be having serious conversations with the banks about what's going on in the deterioration in commercial credit, and they should be, in my opinion, ordering them to increase reserves beyond the growth in impaired loans, so that when the losses actually start to show up on these type of loans, the Canadian banks would then sail seamlessly through it. Now they'd be having lower levels of earnings than they currently have, but on the other side, as the credit cycle actually hits, their earnings would be higher. It's called counter-cyclical earnings management. Now, the Canadian banks don't seem to be doing that, but that's what's prudent, in my view, for bank managements.
If in fact they started to do this, Steve, what kind of earnings deterioration would you actually see in terms of earnings growth? I'm sure you've modeled this out, because the stock price
I have
is going.
modeled it out.
Yeah, what does it look like?
So, if you do a very simple exercise and take the allowance, the loan loss reserves, and divide it by the impaired loans, what you should be hoping for is for that ratio currently to go up. And instead, the ratio is going down. So with respect to Bank of Montreal, Royal Bank of Canada, and CIBC, if we just held the ratio constant versus the first quarter, earnings would, in the second quarter, would have been lower by anywhere from 8 to 14%. Now, if they had done what I think they're supposed to do, is actually increase the ratio, then the earnings would have been down by even more. And that's what should be happening.
And when we spoke last time, Steve, part of the issue is it's up to the banks in many ways to decide how they want to reserve for loan losses. So there's a timing impact for you in many ways going short, because we talked about this before for anyone who's new joining us. There's a cost to borrow and a cost to carry when you have a short position. You're a little bit at the mercy
Correct.
of the bank's CEO's timing.
Well, look, at some point, you can't play these games forever. If you continue to see more deterioration, then at some point, having this allowance divided by impaired loan ratios deteriorates is going to start to look ridiculous. It's already starting to look silly, in my view, but I think we're on the edge where they're not going to be able to manage earnings anymore like this.
Steve, I know you're focused on the company's specific stories and looking at the bank balance sheets and what's going on and how they're reserving, et cetera. But I suppose when you take a look at the commercial loan losses, the impaired losses that we just cited, we have to kind of wonder a little bit, why is that happening? What is going on in the Canadian economy that is allowing or causing that to happen? If in fact we get some type, go ahead.
I think that's a very, very difficult question to answer. I think the Canadian economy is structurally not as strong as it used to be, partially because Canada, as we all know, is a very commodity-oriented economy, and oil production is cheaper in the United States. So the oil industry in Canada, from point to point, I think is structurally weaker. And you're just starting to see this roll through the commercial loan books in Canada, just a gradual weakening. Like I said at the beginning, it's not a calamity. It's what you're going to get is a normal credit cycle. But as far as I can tell, the Canadian bank management is just very ill prepared for that.
So I'm curious, do you ever speak to the Canadian bank management? When we've had them on our network, your call got a lot of attention across the board with portfolio managers as well as analysts. Let's start with that group first. And the call was universally dismissed. You would say what to those portfolio managers and analysts who own some of these banks that you're shorting?
Yes, it was dismissed incredibly dismissively. In fact, I thought the funniest comment of all was one of the bank analysts, I think literally the day after we spoke, said, and I really laughed, this was very funny, he said that that the probability of my being right was so low that it was more likely that the Toronto Maple Leafs would win the Stanley Cup. And I have to say, I have so much more confidence in my theory that I'm feeling pretty good about those Maple Leafs this coming season.
Understood. Well, they've got some time to practice apparently, so we'll wait for that. But what would you say to the But in all seriousness, because these portfolio managers as well manage money for individuals watching our network, you would say what to the individual?
What I would say is the hardest thing in the world, this is one of the lessons of the financial crisis, is to have lived through a certain kind of paradigm for a very, very long period of time, and then to realize that that paradigm is changing. And the paradigm that has existed in Canada for almost 30 years is superior credit quality all the time. And when you live with that for pretty much your entire career, it becomes almost unimaginable that things could be different. And people react very, very slowly to that, especially when, credit doesn't implode overnight. It takes time. Sometimes it's something that happens in slow motion. And when you live in a particular paradigm, it's very hard to change when what the change that is happening is slow.
Mm-hmm. So are you seeing then this will continue to play out almost like a slow bleed? We talked about that last time. And or the catalyst is what?
I mean, the catalyst is, again, you get an increasing formation on the commercial side. And then I think at some point, and I still don't know when that is, but I think it could be soon, you're going to start to see formation on the residential side. And the combination is going to mean that the ability to manage earnings at the Canadian banks will become impossible.
So that's interesting, Steve, because last time when we spoke, you weren't so concerned about the Canadian housing market. And it's interesting that what we did see in this current quarter, that it was the commercial loans that really started to show up deteriorating first. And apparently you can't really tell which one's going to happen first, but they happen. And now it sounds like you're expecting the housing market to follow?
At some point. I mean, I'm not going to make a prediction on what quarter. I think within a year that's going to happen.
Okay.
And so you're going to get a combination of a commercial cycle and a residential cycle.
What would your advice and comment towards the Canadian bank CEOs be today?
Oh, well, first of all, we don't talk.
You don't talk.
So it's not like the Canadian bank CEOs and I have any real relationship. They think what they think, and I think what I think, and we'll see who's right. But we don't speak together.
Why are they so wrong? They've been working hard to diversify their business models to be more international, to be focused on wealth management. The list goes on. Why wouldn't that be the right model?
I'm not saying it's not the right model. Like I said, I am not predicting some calamity in Canada that's going to obliterate the banks. I'm not predicting that at all. I am simply predicting a normalization of credit losses, which the evidence right now is, I think, pretty overwhelming, is happening as we speak.
And Steve, when we take a look at the stock price performance, what's your thought in terms of how you've been performing on this call? The Canadian banks are up. They're not up very much, certainly not compared to U.S. banks. They're better than the European banks, generally speaking. And like I said, I think the risk in the trade is fairly low because the Canadian economy is certainly, at the least we could say, is that it's sluggish. And so revenue growth in the Canadian banks is going to be very tepid, weak. And that's going to continue, I believe. When you look at the timing of this, again, I go back a little bit to the timing of this in terms of whether or not when and if this will play out to your call. What do you expect in terms of how the bank managements are going to react to really try to protect themselves on this call?
I mean, I think, given the history, they're going to probably continue to do what they've been doing, which is manage the reserves to protect their earnings until the credit deterioration is such that becomes impossible. That's what bank managements, and I'm not picking on Canada, that's what bank managements do all over the world.
Stephen, we spoke last time. It seems as though where these stocks go from this current level. It sounded like it was more than 20%. You're looking for a greater than 20% downside. That was when we spoke last time.
You love to try and pin me down on that, don't you?
A little bit. But here's the question. That's what you said last time. I'm just reminding our viewers. But my question is, with what you saw in the second quarter results, given the fact that, our original conversation was about the loan loss provisions. We talked about the capital concerns that you had and that share prices follow capital as capital ratios decline. And now you're bringing up these impaired losses. We got new news on that this quarter. So my question is, are you expecting an even greater decline?
I don't want to answer that question. How's that? I have the same thesis. All I would say is I have the same thesis that I've had. I just think that the results of the second quarter give me greater conviction in that thesis. That's all I want to say.
Okay, and to wrap it up as to where we started, you've been adding to your positions on that greater conviction.
I've been adding, not tremendously, but I'm adding a little bit to the positions. That would be an accurate statement.
Okay, to the positions. Royal, you've said this before, Royal, Laurentian, and CIBC.
That's amongst three of the positions that I have. I have a few others as well.
Okay. Did the second quarter cause you to put on some new positions, new names?
No, I haven't put any I haven't put on any new positions on.
No new names. All right. Steve?
Not since we spoke.
Okay. Since last 2 months ago.
Right.
So nothing on the second quarter that caused you to add on another name.
Let's talk next quarter. Maybe we'll have a different conversation.
Okay. Steve, we'll leave it there. I appreciate your time. We appreciate your time as always.